more hits we play, the more hits we get. URLradio.net. Stacey Sturm. And in the studio for another Financial Friday, I have my financial gurus from Solid Rock Financial. I have Brian Bloom and John Dwyer. How's it going today, guys?
Great, Stacey. How are you doing?
Good.
Doing good.
Today we're talking about retirement, right?
We are.
When people worry about money, it's two worries. One, how am I going to pay my bills now? And two, how am I going to set myself up to retire?
So what I want to talk about today is,
Okay.
in relation to retirement, is that helping people understand that there is 3 different types of buckets that we can characterize all the assets into for distribution. And we want to help people understand that there's primarily 3 buckets. And we want to focus on what the distribution rate is going to look like as it relates to where those monies sit in relation to the asset class, right? So the 3 different types of buckets are always taxed, partially taxed, and never taxed or tax-free.
Okay.
And so in this segment, the first bucket that we really want to focus on is what we call the always taxed bucket in distribution for retirement income.
Okay.
Right? And so to classify those assets, that would be your IRAs, your 401ks, your SEP plans, your 403B plans, your KEOG plans, your 450. Those types of accounts is what we characterize as an always taxed bucket in distribution, because what you have done during the accumulation phase is you have taken deductions or reduction of your income to put the money in those accounts, so the money has never been taxed.
Okay.
So as in distribution, as you pull the money out, what happens to those dollars?
Well, I'd say a good portion of it ends up finally getting taxed.
It's always going to get 100% taxed.
And John, the always tax bucket, the problem there is, we took the tax deductions, and when we did it, it was at a tax rate we knew. The problem with being always taxed, it'll be at a tax rate that we don't know what it's going to be. See, a lot of people don't know that your money that's in your employer savings account, the 401k, it's going to be taxed at whatever the tax rates are when you take it out. It's not going to be at the tax rate that you deferred.
Right.
Or postponed. It's going to be taxed at whatever the government happens to set their tax rates are the year you pull it out. And go back to the conversation that we had last week about tax rates.
About tax rates,
right? And where we sit, are taxes going up, down, or staying the same?
Right.
As it relates to your income, your threshold, and the tax rate, right? So we're going to take a look at just having $1 million in this bucket.
Okay.
All right. Now,
at retirement. So,
at
so
retirement.
you may have heard, what's your number?
Yeah.
And so we're going to use the what's your number is $1 million.
It's $1 million. Yeah.
Okay.
Now we're going to use what we call an 8% distribution rate hypothetical example to keep the numbers simple.
Okay.
By no way are we advocating an 8% distribution rate.
8%. It doesn't mean we're going to earn 8%.
Right.
We're going to take out 8%, which means we might run out of money in that bucket.
Okay.
If you were to pull out 8% a year.
Right.
Yes. Okay. So, but just for hypothetical purposes, we just want to understand that if you have $1 million in the account and we have an 8% distribution rate, Stacey, how much income is 8% of $1 million?
Oh my God. Well, 10% would be like 100,000. So then 8% would be like 80,000.
$80,000. Okay. So you have $80,000 that's going to be reported on your 1040 as retirement income because you pulled $80,000 out of your bucket.
Yeah.
Now, what haven't you done yet?
I haven't paid taxes on
You
that.
haven't paid tax yet.
Yeah.
Right? So if let's just assume a 35% tax rate, right? Mm-hmm. Well, that's $28,000 in tax.
Yeah.
So now your $80,000 of reportable income.
You're welcome, government.
Yeah, you're welcome. Here's your thank you note.
You get a 1099 telling the government how much you took out.
Yeah.
And that it's all taxable.
Yeah.
Which leaves you with a spendable income of $52,000.
Right.
Now I'm going to transition this conversation over to Brian because he gets really fired up about what we call the how dare you tax.
Yeah, there's a secret tax in this. Not only did you pay the $28,000 of income taxes on that distribution, but anytime you put any amount of money over $44,000 of taxable income on your income tax return, your Social Security then becomes taxable to the extent of 85% of what you receive from Social Security. Now, I'm not saying that you're going to have to pay 85% tax. I'm saying 85% of your Social Security is taxable
Right.
at whatever your highest income tax rate is. Okay?
Wow.
Now remember, Social Security is something you never took a tax deduction for.
That's true.
And so in a way, if the Social Security becomes taxable later, when you put the money in, gave the money to Social Security, it was taxable. Now when it's coming out, it's taxable. That sounds to me like double taxation. However, in this case, it's with representation. You know, we threw tea in the harbor.
Yes.
Because double taxation without representation. Well, these guys know what they're doing. This is double taxation with representation. I call it the how dare you tax.
Right?
How dare you have thought ahead to plan for your retirement years by putting money in your employer's 401k plan or your self-employed pension plan or your IRA. How dare you have more than your neighbor whom we can't even pay their Social Security benefits to.
Right.
So let's take a little bit of what you now have too much of, which is Social Security. Let's take a little bit of that and let's give it to your neighbor, because otherwise we can't afford to do it.
Right.
That's the how dare you tax.
See, and it's all because it comes back to retirement income streams.
Yeah.
And this bucket of always tax, see, this is an example of a pretty good accumulator, but a terrible distributor of your wealth.
Right.
Because of the tax rate. We have, no idea what bracket that you're going to be in. We have no idea at what rate. So really, there's not one financial advisor that can systematically tell you how much income you're going to have year by year in distribution. We don't know.
Right.
We have no idea.
You can look at rates of return. This is what I made you.
Right,
But at the end, you can't.
But understand,
you can't
we're not
say
even
how
talking
much
rates
you
of return.
get.
It has
I know.
nothing to do with rates of return. It has everything to do with the tax rate.
Right. And when you think about it, someone who's in that average Social Security, maybe they're getting $20,000 a year from Social Security, that tax is like $5,000.
Yeah.
And you know, Social Security, rarely does anyone withhold taxes from their Social Security payments. And so especially that first year this happens, it's a big surprise.
Right.
Because all of a sudden you owe $5,000.
Yeah.
Because you didn't plan on that, because this is a stealth tax. It's something that we didn't know about. And it hurts.
Yeah.
So you got to plan ahead, because you don't really want to have money sitting on your tax return in retirement, because that makes your Social Security taxable. How dare you?
How dare you take the initiative to not rely on the government for
And
the rest of your life?
Right, and it really doesn't matter who's in office. Government's got to raise money in order to pay for everything we haven't paid for. This is one of those ways, and it does not part along party lines.
No.
Doesn't matter.
I'm kind of mad now.
You should be.
So again, it's just helping you understand. And as we categorize these different types of buckets in the always taxed, and that's why we really spend so much time on helping clients understand distribution, because that's the whole reason why they're positioning their assets for future retirement. It's how you pre-pack your bags in retirement to where you position those assets. And it may or may not be the right move to put money into a 401k or a qualified government-sponsored plan.
You want to do it in the most tax-effective way possible.
We help our clients create wealth in the most tax-efficient manner.
So if I come to you and I want you to help me plan for my retirement, what do I need to bring? What do I need to do? What do you guys want from your clients?
Well, we have a process that we help our clients walk through, and Misty at our office would get that to them. But we have a questionnaire that asks for all the financial data. It's kind of our blueprint to kind of see where their buckets of money are sitting and where they are not being used efficiently.
Okay.
And we just help walk them through and educate how all these characteristics and these asset classes really truly work. Okay. And so there is a financial data form that we fill out. There's other things that we'll send to the client that they'll complete for us. But Misty at our office would be the one to get in contact with and schedule a time with me to go through that with you.
Okay. And how can they get a hold of you guys?
You can get a hold of us at 701-223-1000. Our website is www.srfinancial.net. You can email me at john, John, at srfinancial.net.
Okay. And how about you, Brian?
I think just using that same contact information in John's office and talking to Misty and getting one of those questionnaires would be a great way to get that started.
All right. Thanks, guys.
Thank you.
We'll be back with more Financial Friday on urlradio.net.